Today in accounts we'll start lesson number 3, valuation of goodwill. The weightage of this lesson is total 6 marks. That is 1 mark MCQ, 1 mark in section B, question, one short question is there, and in section D there will be one sum which carries 4 marks. So that is how it becomes to 6 marks. We'll start, that is goodwill. First of all, what do you mean by goodwill? In 11th standard already you have studied that what do you mean by goodwill. Okay, goodwill is one type of intangible asset. Intangible asset was coming under the heading of non-current asset. Okay, and non-current asset was coming under the heading of asset side. So this is how our asset side in balance sheet was divided into two parts, that is non-current asset and current asset, and our non-current asset was divided into 3 parts, that is intangible asset, fixed asset and long-term investment. This all you have studied in 11th standard in final account. Once again we'll do the revision. Okay, what do you mean by intangible asset? Intangible assets are those assets which we cannot see. Okay, tangible assets are those assets which we can see, for example land, goodwill, all these are tangible asset. Okay, and intangible asset means goodwill is there, patent, trademark, copyright. Okay, these all are coming under the heading of intangible asset. Okay, now let us see the first paragraph, that is introduction in textbook, that is on page number 89. See now, in practical reconstruction of partnership firm, as per the circumstances, assets and liabilities revalued at the time of reconstruction of partnership. That is, we have studied in lesson number 4, reconstruction of partnership, when the ratios, P&L ratio of a partners are changed. Okay, it is reconstructed. So under that circumstances we were also revaluing the asset and liabilities value. Okay, see, issue of valuation of goodwill is taken place with revaluation of asset and liability. Okay, if your asset and liability is revalued means, suppose previously your asset, land and building was of 1 lakh, but now the current value of land and building is 1,20,000, so it has been increased by 20,000. Same way it can be increase, there can be increase also, there can be decrease also, so it depends, okay, upon the situation or upon the market. So when you are revaluing the value of your assets and liabilities, same way you have to revalue the value, that is either you have to revalue the amount of goodwill or there arises a need for the valuation of goodwill. Okay, now see, this is all revision part. Okay, first of all, there are 2 types of asset, non-current asset and current asset. Okay, non-current asset with the assets which are for long-term period, and current assets where you can easily convert into cash, and these assets are for short-term period. So this is all your 11th standard revision. Intangible asset, fixed asset and long-term investments are included in non-current asset. Goodwill, patent, trademark, copyright, etc. are included in intangible asset. Again I'll do the revision, that is what do you mean by goodwill, patent, trademark and copyright. Goodwill is nothing but the monetary value of the reputation of the firm in the market. Okay, again I'm repeating, goodwill means the monetary value of the reputation of the firm in the market. Patent, what do you mean by patent? So again, patent is an intangible asset which we cannot see, that is the valuation of some design. We were discussing patent. Patent means that is the design or some formula which we will own, that is on that design only our right will be there, nobody else will use that particular design. So when you are owning your own design or some formula, that is known as patent. Trademark, that is some image or some photo which you are keeping. Okay, you all know that Amul, there is a girl standing as a logo. Okay, so any type of logo or any type of design or drawing which is specially used for that product only, nobody else can use that, so that is known as trademark. Copyright means to publicly issue any of the thing. Okay, that is any T series cassettes or anything, so they have their own rights. Okay, they can only issue that particular cassettes, okay, in the market. So this is nothing but this is known as copyright, their own right to issue that thing in the market. So this is all nothing but these are all intangible assets. This type of assets cannot be seen, but they have a value in the market. Goodwill is also an intangible asset which cannot be seen, but it has its own value. Okay, we'll see further. Over a period of time, a well-established business develops an advantage of good name, reputation, and wide business connections, which benefits the business. In accounting, monetary value of such advantage is known as goodwill. Okay, that we have already seen. Now see, in simple words, this is very important for 1 mark. Remember, because both the concepts are coming in this, that is goodwill is an intangible asset and the reputation of a firm. Okay, so see, goodwill is an intangible asset which shows the reputation of a firm in the market. Again further, goodwill is the value of reputation of a firm in respect to the profit earning over and above the expected profit. For example, if our expected profit is rupees 1 lakh and we are earning profit this year, that is rupees 1 lakh 20. So 20,000 extra we are earning what to the amount which we have expected. So this 20,000 is only because of a goodwill which is existing in the market. Clear? A goodwill a firm has a goodwill which has the capacity to earn more profit than a common firm, and it is due to its own reputation, because maybe they have some stable customers that are regular customers or any other reason. Value of goodwill depends on the profit earning capacity of the firm. Again, remember this for board exam, that on what basis the valuation of goodwill takes place. So we have seen that the value of goodwill depends on the profit earning capacity of the firm. More the profit, more amount of goodwill. Less the profit, less amount of goodwill. So in short, we can say that goodwill does not exist in those business which earn normal profit or incur loss. Now next point, that is where the goodwill is shown. Now as we have previously discussed that goodwill is intangible asset, so that much we know that it is always shown in the balance sheet, that is on asset side. Now remember, under the heading of non-current asset as an intangible asset. So this can also be asked, that where goodwill will be recorded. Okay, now the next concept which we are going to study, that is factors affecting valuation of goodwill. Which are the factors which will affect our amount of goodwill? Okay, that is, because of these factors the amount of goodwill can increase also, it can decrease also. So see the first factor, that is nature of business. See, we'll see goodwill exists when a firm earns more profit than the expected profit. It earns profit due to high value added product, it has more profit margin due to stable sales, or it earns more profit due to some other reason. In short, in nature of business is only that point is covered, that if you are earning good amount of profit and your business conditions are good, then the amount of goodwill also will be high. Okay, if your business conditions are not suitable and are not good enough, that is your profit amount is not a regular basis, or there is a fluctuation, sometimes it increases, sometimes it decreases, sometimes it also goes into loss. So because of all this nature of business, the amount of goodwill is also affected. Second point we'll see, that is location of business. Okay, see, location of business, general simple example I would give, that if your shop is in the heart of the city, that is, it is located in the main market, then you will see more good amount of goodwill. But if your shop is not located in the market, but it is somewhere located in the residential area or somewhere else, okay, or where more people are not residing, so there you won't be able to see good amount of profit. Okay, so location of business also varies the amount of goodwill. See now in that, often the profit earning capacity of the business depends upon the business location. If the business is centrally located or it is at a place having heavy customer traffic, then more profit earning capacity, that is more profit earning can be seen. It means where there is heavy customer traffic, means normally there are always customers seen in that place. Okay, so that is the main market. So here you will get good amount of profit. So if good amount of profit is earned, then amount of goodwill will also be good. So the value of goodwill is high at such centrally located business. Thus business location also affect the value of goodwill. We'll see further. Point number 3, that is period of business. See now in this. Generally older the firm, higher the reputation in the market. Okay, because majority of the customers are familiar and they have very close and long-term relations with the customers, particular business unit. Consequently, the value of such business is bound to be high. Thus, the period of business also has an impact on the value of goodwill. See, you have seen Raymond's, whenever they are doing ad or whenever some advertisement is coming, they are always writing since so and so year. So they are not only just mentioning that this is the beginning year of their business, but they are showing us that how old the business is. Okay, so here the period of business, as old as the business hold, okay, the market, that is they have power holding the market, so the goodwill amount also will be high. Next, see, market situation. Under monopoly and competition, that is limited competition, okay, always the amount of goodwill will be high. Why? Because in monopoly you will have your own market, okay, you can decide the price what you want, okay. Competition is not there. Here also you can decide what price, at what price you want to sell the product. So in both the condition, the amount of profit will be high, and subsequently the amount of goodwill will also be high. Thus the value of goodwill also depend on the situation of the business in the market. Next we'll go, that is efficiency of manager. The efficient management of a business increases the production and decreases the cost of a firm. Due to it, profit increases, which increases the value of goodwill. Now see, I'll explain with an example, that if previously the cost of production, for example, I'm taking soap, okay, the price of that soap is ₹15, which is available in the market for customers, okay, this is the selling price. Now the cost of production, that is if the company is manufacturing that particular soap, okay, it costs ₹12 to the company. So ₹3 margin of profit they are keeping, and then they are selling this to the customer at ₹15. Now the same soap, same quality, everything is same, but the cost of production has been decreased to ₹10 from ₹12, because there is a new manager who has been appointed, and because of his efficiency and hard work, and he has cut off some of the expenses, and because of all his work, because of his knowledge, he has reduced the cost of production from ₹12 to ₹10. Now previously with manager A, that is the cost of production was 12 and the selling price was 15, so only ₹3 profit was there. Now with this new manager B who has been appointed, because of his efficiency, the cost of production price is ₹10 and the selling price is 15, so automatically the margin of profit has increased from ₹3 to 5. Okay, so this was an example. So because of this efficiency of a manager, we can find out that sometimes the cost of the firm decreases, and because of this the profit ratio increases, and subsequently the amount of goodwill also increases. Next point is other special benefit. Goodwill exists when a company enjoys special benefit. Okay, overall profitability increases in that circumstances. For example, see, if a company acquire license, patent, trademark, more profit and more earning of profit, subsequently there will be high amount of goodwill. Okay, now for example, I'll say cyber cafe I take. Okay, if a cyber cafe is not having a license, okay, normally there will be no more customers going to that place, because they always have a fear that this particular cyber cafe is not having a license, there can be any risk. Okay, so if a place which is having a license and you're going in that cyber cafe, so number of customers will be more here. Okay, as number of customers are more, so more amount of profit will be seen. Same way goodwill also will be more. So this is nothing but this is one of the example that is special benefit. Clear? So these are the factors which can affect the business, okay, in the market. So here this can be asked that write down any two factors which are affecting the valuation of goodwill, or explain the factor affecting goodwill, that is in context to market situation or in context to efficiency of manager. So like this, okay, because the whole answer won't be there because it is of only 1 mark. So like this it can be asked to you, okay. Now let us start with the point number 4, necessity for the goodwill valuation. Normally the need for valuation of goodwill arises at the time of sale of a business. In context of a company, the need of valuation of a goodwill arises at the time of amalgamation and absorption. Okay, see, now there are 2 points. First, that is sale of a business. That is normal business. It can be firm, it can be partnership, anything. But there you need to find out the value of goodwill only when you are selling the business. Now in context to company, if it is not a firm, if it is not a partnership, or if it is not a sole proprietorship and it is a company, then in case of company, when you want to find out goodwill, that is when the necessity of goodwill valuation arises. So in case of amalgamation and absorption, I'll explain in detail both the points. See, if it is a sole proprietor or partnership, or if it is a firm, when you are selling your business, okay, why do we want to find out goodwill? Suppose, see, the whole business, whatever your assets are there, furniture, machinery, it is there in the business, land is there, okay, totally you are selling all that in rupees 15 lakhs, okay. Now this is your selling price of the asset, but there is a party who is ready to pay you 18 lakhs, okay. The amount of asset was 15 lakh, but the party is ready to pay you 18 lakhs. Why he is ready to pay you 18 lakhs? Because the reputation of that particular business is very good, okay, and for that reputation, for that goodwill, he is ready to pay you extra 3 lakhs, okay. So that is in case of a partnership, in case of firm, partnership firm, or in case of sole proprietor, okay. That is, during the sale of a business, there is a need to find out the value of goodwill. Now if we go to company, when it is needed to find out the value of goodwill, so in case of amalgamation and absorption, okay. Now what do you mean by amalgamation? Amalgamation, I'll just give you a short example, that there are 2 companies, company A and company B. If both the companies are coming together and forming a new company, that is company C, so that is nothing but that is known as amalgamation, which we can say that merging of 2 company, okay. That is 2 companies are coming together and they are forming a new company, which is company C. So both the companies have to find out their goodwill and then they will do the amalgamation. Next is absorption. What do you mean by absorption? So see, absorption means, again there is, I'll give you an example, that company A is there, company B is there. Company A is very strong, okay, financially also, and in market also it is strong. Company B, somewhere it is lacking and it is a weak company. So company A will take over the company B, and this is known as absorption, okay. That is, one company take over the other company, okay. So in case of company, during amalgamation and absorption, we need to find out the value of goodwill. And in case of partnership firm or sole proprietor firm, that is at the time of sale of a business, we need to find out the value of goodwill. Clear? Further, see, in the context of partnership firm, it may also arises in the following circumstances. Now see, in case of partnership, these are the other reasons that during partnership it is possible that we need to find out the goodwill. First, change in profit sharing ratio. So when the partners, suppose A and B are the partners, previously their ratio was 1:1. Now their ratio is 3:2. So as the ratio among them is changed, so the value of goodwill also will be revalued, okay. So in that case, we will find out the amount of goodwill. That is, we need to find out the valuation of goodwill. Second, admission of a new partner, okay. Suppose there are 2 partners A and B, and the new partner C is coming in the business. Till now, whatever the business is run, suppose the business has been run since past 5 years. So till 5 years, what is the value of goodwill? That amount of goodwill you will charge from the new partner, because he is coming to a ready-made business which has been already started since last 5 years back, okay. So he is coming now in the 6th year. So till 5 year, whatever reputation you have created, so for that reputation you will charge the amount of goodwill from the new partner, and for this purpose there is a need to find out the value of goodwill, okay. Third point, retirement of a partner from existing partners. Now when the partner is going as new partner is coming, he brings goodwill. So when some partner is going from the business, he will take his share of goodwill also along with him while going. Okay. In case of death, so if some partner is dying, okay, so in that case also the family members will be given the part of his share of goodwill. Conversion of partnership firm into company. When you are converting a partnership firm into a company, in that circumstances also we need to find out the goodwill. Okay, then further, amalgamation of partnership firm, that is already I have explained in case of company that when two companies are combining. So here there are when two partnership firms are combining. For example, A and B are partners and they are having a partnership firm. Same way others partners are there, C and D, and they are having some other business. Now this all four partners are coming together and they are combining their businesses. Okay, so in that case also they have to find out the valuation of goodwill. Amalgamation means two partnership firms join to start a new firm. Clear? If in case if they are asking what do you mean by amalgamation of a partnership firm, so this will be your answer of one line, that amalgamation means two partnership firms join to start a new firm. Okay, example I gave now, that A and B is there and C and D is there. Now when four partners are coming to together, they will form a new business, new firm. Okay, so this point is clear. Necessity for valuation of goodwill, that why do we need to find out the goodwill amount. Okay, now let us start the fifth point, that is on page number 90, method of valuation of goodwill. Okay, we have already seen what is goodwill and everything. Okay, now there are that is we have also seen that why we need to find out the value of goodwill. Now there are few methods. Okay, there are various methods to find out the goodwill. In short, remember, see the thing that is generally following method are used for the valuation of goodwill. Four methods are there: average profit method, weighted average profit method, super profit method, capitalization of profit method, and one more is there, that is fifth one, that is, see, the fifth one is, that is super profit capitalization method. It means that the third and the fourth method is combined. Only the last step is different in this fifth method, that is super profit capitalization method. Okay, so the fifth one is an extra method which is given to you in textbook. Otherwise, just remember, if they are asking how many methods are there, so write down only four methods are there, that is average profit method, weighted average, super profit, and capitalization profit. Okay, so now for theory purpose, just to make the concept clear, I'll explain what do you mean by average profit method. Okay, this is the first method. See now, under this method, the average profit of past certain years is taken into consideration. Okay, add here, that is average profit. Okay, so average profit is to be multiplied by the certain number of years of the valuation of goodwill. It is based on the assumption that a new business will take certain time. Okay, to earn the same profit. Therefore, the business purchase is ready to pay the value of goodwill equal to the number of years of average profit. Generally, the multiplication of average profit and the number of year during which anticipated profit expected is known as goodwill. See, in short, what they have written, no need to remember all this. Only remember that what is first. In this method, first you have to find out average profit. How you will get average profit? So total profit of the given year. Okay, for example, they have given you 3 years, then you will add up that 3 years and you will divide that amount with the number of years, that is 3. Then how to find out goodwill? So whatever average profit you have gained, you have to multiply it by the number of purchase. Okay, number of years of purchase, that is whatever defined year they have given. Okay, see here there is an example. Illustration 1 is there. Okay, the amount of profit for 5 years is given to you. You will add up this profit. Okay, after adding up, how many years are there? So 5 years is there, so you will divide it by 5 years, you will get this average profit. Now this average profit, in the question C they have given that the based on 3 years of purchase. See here, based on 3 years of purchase, so your purchasing year is of 3 years. Okay, don't see that 5 years. 5 years are these 5 years. Okay, here the purchasing year is of 3 years. Okay, so this you will multiply, that is average profit, you will multiply by this amount, so you will get that is 6,21,000. that will be the amount of goodwill. Now here as profit is there, if there is for any one of the year, if there is loss given to you, then as profit you are adding, so your loss will be deducted. Okay, so take that thing also into consideration. Now let us start our second method, that is weighted average profit method. But before that, let us see what is the limitation, why this method, weighted average profit method, came into consideration. Because of the first method there were some limitation, so because of that limitation the second method came into existence. See, if they are asking also in board exam that what is the limitation of average profit method, okay, so see here. Okay, in simple average method, calculation of goodwill is based on assumption that no change in the overall situation of profit is expected in future. Okay, remember this second line. This method does not consider the increasing or decreasing trend of profit. Okay, and because of this reason the second method came into existence. Okay, capital employed is also not considered. So all these points are there, and because of that reason, that is, the second method came into existence. Okay, now see what is weighted average profit method. We have seen that in simple average method the trend of profit is neglected. Sometimes it can be seen that there is continuous increase or continuous decrease. Okay, under such circumstances we should give more weightage to the profit of recent years, comparatively less weightage to the profit of previous year. Generally the weight of the year are numbered as 1, 2, 3, 4. So see, for example, here it is given. Okay, see, this is the recent year. Okay, this is the recent year 15, 16. So here the weightage is given more. 12 and 13 is the past year, so here the weightage is given less. Okay, so the current year will be given more weightage. As the years are going in past, the weightage will go on decreasing. Okay, so this is the line which they have told. Okay, average workout after giving weightage to different year of profit, it is called weighted profit. Okay, so see here, when you multiply the amount of profit with the weight, the multiplication of this two is known as weighted profit. Okay, if specific instruction is given that compute as per the weighted average method or every year increasing or decreasing 10, then compute goodwill as per weighted average method. See, now for this I will just only say that if it is already given into the question that do the sum by weighted average method, then you have to do this method. The second thing, sometimes they are not mentioning that you are supposed to do the sum by this method, but they have only said that use appropriate method. Okay, so in that circumstances how you will decide to use which method? See, remember, for weighted average profit the trend should be either increasing or the trend should be either decreasing. It means the profit should be continuously either increasing or the amount of profit should be continuously decreasing. When there is fluctuation in the profit, increase, decrease, that in that case you should use only average profit method. You will not use weighted average profit method. For this I'll show you. See here the amount of profit: 13, 14, 40,000, then 50,000, then 60,000, then 70,000. It clearly visible that the amount of profit is continuously increasing. So here you have to use compulsory weighted profit method only. Whereas in this sum, see illustration 1, the amount of profit 2 lakh, then increasing it is 2,10,000. Now it is decreasing, see 1,90,000. Now again increasing 2,15,000, again increasing 2,20,000. So increase, decrease. So you will use, that is, average profit method. So remember, when profit is increasing and decreasing, okay, you will use, that is, first method. Okay, that is average profit method. Okay, but when profit is continuously increasing or continuously decreasing, okay, under this circumstances you will use the second method, which is weighted average method. Is that clear to all of you? Okay, so like this, remember. Okay, now we will see our third method, that is super profit method. In this method, capital employed by business, expected rate of return of expected profit, average profit, etc. are used for super profit. The excess of average profit over expected profit is called super profit. Remember this line because this is also asked for 1 mark. Okay, that is, what do you mean by super profit method? So the excess of average profit over expected profit, okay, that is known as super profit. Okay, you can say it in the formula wise also. See, what is the formula of super profit method? So super profit is equals to average profit minus expected profit. Okay, remember this formula. Sometimes the students are doing expected minus average. Okay, so you can remember in shortcut way that in an alphabetical order A comes first and then E comes, that is A, B, C, D, E. So A comes first. So in super profit method, what you will write down in formula, that is average profit minus expected profit. And here what you will do, the excess of, again here also same, the excess of average profit over expected profit is called super profit. So just remember, A will come first and then E will come. Okay, so like this, remember. So when a business earn excess profit over average profit, then the amount of excess profit is called, that is super profit. On the basis of super profit, valuation of goodwill is made. See, now whenever you are supposed to do by this method, super profit method, simply you have to remember this 6 step. Okay, so for super profit method, you will remember 6 step, and these are the 6 step, that is CEE as G, that is CEE as AS as, and then G. Remember the 6 steps. Okay, then further you can do the sum whole easily, very easily. Okay, see the first step, that is capital employed. What do you mean by capital employed? So total asset minus total external liability. Okay, second, expected rate of return, that is already given in the question. Then third, expected profit. What is the formula of expected profit? So capital employed multiply by expected rate of return upon 100. Average profit after adjustment, average profit, see this average profit can be anything. Okay, this average profit can be either by average profit method or by weighted average profit method, whichever is applicable. I have taught you how to see if the fluctuation is there in the amount of profit, then you will use first method. If the profit is continuously increasing or continuously decreasing, then you will go for weighted average profit method. Then fifth step, that is super profit, so average profit minus expected profit, and then at last goodwill is equals to super profit into number of purchasing year. Okay, so see these are the 6 step. First, capital employed. Second, expected rate of return. Third, expected profit. Fourth, average profit. Sixth, super profit, and fifth and then sixth, that is goodwill. Clear? Remember, capital employed is also known as net asset. Sometime in board exam they can say you that net asset is of rupees this much. So you have to remember that capital employed is equal, that is both are same. Okay, either they can say you as capital employed or they can say it as net asset. So both are one and the same. Now let us start our fourth method, that is capitalization of profit method. In this method, average profit of business is computed and it is used to determine its capitalized value on the basis of normal or expected rate of return. In this type of profit, the profit which is arised is known as capitalization of profit. Now thus capitalized profit, learn this. Okay, as we have learned super profit, so capitalized profit means, okay, capitalized value of average profit on the basis of expected rate of return. That is the average profit, okay, which we have used on the basis of capitalized value, that on the basis of the expected rate of return we have to find out. See how it is in the formula way. Capitalized profit is equals to expected profit upon rate of return into 100. Okay, so remember this, expected profit upon expected rate of return multiply by 100. This is the formula for capitalized profit. Okay, now see here the steps are given. Okay, in super profit there are 6 steps. In capitalization method there are 5 steps, CEA CG. See, first step is same, capital employed, that is total asset minus total liabilities, or we can say it as net asset. Again second step is also same, expected rate of return. See here The third step is, that is average profit. In that super profit method, the third step was expected profit. Here in this case, no need to find out the expected profit. Okay, directly you will come to the fourth, that is average profit. After that you will find out capital profit and then goodwill. Okay, here the formula of goodwill is capital profit minus capital employed. Okay, that is 5. How you will remember? So 4 minus 1. Okay, that is fourth is capitalized profit minus capital employed. Clear? So these are the 5 steps for capitalization method. If the answer of step number 5 is 0 or negative, then no goodwill exists in the firm. Clear to all of you? Now see the 6th method. Okay, that is super profit capitalization method, which is a combination of both the methods. Okay, so here in this case, see, steps are same. That is the 6 steps which you were supposed to find out for super profit, that is CEESG. Okay, so see, first is same, capital employed. Second is also same, expected rate of return. Third is also same, that is expected profit. Fourth is also same, that is average profit. Fifth, that is average profit minus expected profit, which comes to super profit. Only the 6th one is different, that is goodwill. There, what was the formula? So in goodwill, it was super profit multiplied by number of purchasing years. See. Okay, you can see here, goodwill is equals to super profit multiplied by number of purchasing year. And in this case, what is there? So it is like this, that goodwill is equals to super profit upon expected rate of return into 100. Okay, so under this method you are only supposed to do, that is the change in the 6th step. Clear to all of you? Now let us start our exercise, that is on page number 105. Okay, question number 4. See, we'll read the sum. This sum will be for 4 mark in board exam. Okay, from the following information of Bhavesh and Vipul's firm, compute the value of goodwill on the basis of 4-year purchase. See, 4-year purchase, that means at the end when you are supposed to multiply it by profit, average profit, okay, either by weighted or simple average profit. Okay, you have to take into consideration this 4 years, that is, this is your purchasing year. And the data of last 5-year average profit is given to you. Information of the last 5-year profit is as under, that is year and profit is given to you. Please write down this always when you're writing in board exam, because this also carry 1 mark in board exam. Okay, do not directly start your answer from here, that is average profit is equals to total profit upon total number of years. Okay, what some students are doing, they are not showing this part, they are directly starting the sum from here. Okay, as this sum sometimes carry that is usually it carries 4 marks, so the marks are divided, that is 1 mark is for this step, that is here you are supposed to show that what is the total amount of profit. So the total amount of profit, when you do the addition of all this, it comes to 7,40,000. Clear? So this is a part of your answer. You have to write down the year, you have to write down the profit. If this you are not writing, then and you are starting your sum from here, then you will get only 3 marks. Okay, is that clear to you? This carries 1 mark, so please show this in your exam also. Okay, now what you are supposed to do, so average profit is equals to total profit, which is equal upon total number of years. So see, now what do we get total profit? So the total profit is 7,40,000 divided by the total number of years, so it comes to 5. When you divide this, the answer comes to 1,48,000 rupees. Okay, so this is your average profit. Clear? Now what you want to find out, they have told you to find out the amount of goodwill. So how you will find out the goodwill? Again you have to write down this, do not show directly multiplication. So goodwill is equals to average profit multiply by number of, now multiply it by number of purchasing years. Okay, so what they have given, average profit 1,48,000 multiply by the number of purchasing years. To us it was given that is 4 years. Okay, the 4 years purchase, so we will multiply it by 4. So what do we get? 1,48,000 multiply by 4, so that comes to 5,92,000 rupees. Okay, so this is your amount of goodwill. Okay, so see how you will get the marks. So the weight 4 mark sum, if it is asked, then this much is for 3 mark and this portion is for 1 mark. Okay, so 1 year, here it is of 2 and this is of 1, including this line. So do not show directly the multiplication, you need to write this average profit multiply by number of purchasing year. Now one more thing, see here how the profit is there given, 1 lakh, then 1,10,000, increasing, then again increasing, then again increasing, and then decreasing. So I have told you, then when there is increase decrease, you will always use average profit method. Okay, second thing, see this years in textbook it is directly given. Sometime if they want to make the twist in board exam, what they are doing, they are just not giving in a sequence. Okay, they will just jumbled up. So when, for example, here it is given to you that is 11 12, so they can give you like that 11 12, then 13 14, then 14 15, then 15 16, and then 12 and 13. Or it is given in a reverse order, that 15 16, then 14 15, 13 14, 12 13, then 11 and 12. Okay, so always remember, when the years are not in a sequence, first you have to arrange them in a sequence order and then you will check that how the amount of profit is given. So please always remember that the years are not given in an order, then you have to keep them in an order, and then after keeping them into an order, then only you have to check the amount of profit, that how it goes. Okay, so take that thing into consideration. Now let us start question number 5. Mahendra and Praveen are partners of a firm sharing profit and losses in the ratio of 3:2. See, first of all, in this chapter, you are not supposed to do anything with the ratios. Okay, so if they have given the ratios, just ignore that ratios. Okay, they want to change their profit sharing ratio to 1:1. Therefore, they have decided to make valuation of goodwill. As per the partnership agreement, value of goodwill to determine on the basis of 5-year purchase of the last 4-year average profit. See, 4 years are given to you, and what is the purchasing year? So your purchasing year is 5 years. Okay, so your purchasing year is 5 years. See, in this particular sum for the year 15 and 16, the amount is given in the bracket. Amount given in the bracket, it means it is a loss. Okay, and loss, what you have to do? So you have to minus it. Is that clear to you? Okay, loss, whenever the amount is given in bracket, it is loss and you have to minus it. Okay, now see, when we'll start the sum, here we have written. Okay, and how we will decide? 60, then it is increasing, then again loss is there, it is decreasing, and then decreasing. So again in the sum there is increase and decrease. So as there is increase and decrease in the amount of profit, so we will go again by average profit method. See, now what is the total profit here? So 60,000 plus 80,000, this is loss, so we will deduct, that is minus 20,000, and then plus 30,000. So the total profit comes to, that is 1,50,000 rupees. Okay, so again what we will find out, that is average profit is equals to total profit upon total number of years. Okay, so what is the total profit? 1,50,000, and number of years, so 1 2 3 and 4. So when you divide this 2, you get, that is 37,500 rupees. Okay, this amount you are receiving. So this is your average profit. Clear? Now we will find out, therefore goodwill, what will do? So goodwill is equals to average profit multiplied by number of purchasing years. Clear? Now average profit is 37,500 and number of purchasing year, it was 5. See here it is given, okay, that is the number of purchasing year, that is 5 years. Okay, so when you multiply it by 5, what do you get? So you get that is 1,87,500 rupees. So this amount is your goodwill amount. Clear? So 1,87,500. Now let us start question number 6. From the following information, find out weighted average profit. See, in this sum, they have not told you to find out the amount of goodwill. They have only told you to find out the amount of weighted average profit. Now they themselves have told which method is there. See, if we compare the profit, 60,000, 70,000, 90,000 and 1,10,000. It means the profit is continuously increasing. I have taught you when the profit is increasing, decreasing, then you have to go with the average method. And when it is continuously increasing or continuously decreasing, there you have to go with the weighted average profit. Okay. So now we'll do the sum. See here I have written that is year and profit. Okay. So this is the condition. Now what will add here? We will write down here weight. And I have told you that every time the year should be arranged properly. Okay. So when we write down the weight is 1, 2, 3, 4. The total of this, that comes to 10. Okay. After writing this, now we will find out weighted profit. Okay. So what you will do, you will multiply these two things. That is 60,000 multiplied by 1. You will get that is 60,000. Okay. Then 70,000 multiplied by 2. So it will be 1,40,000. 90,000 multiplied by 3. So it will be 2,70,000. And 1,10,000 multiplied by 4. So it will be 4,40,000. Okay. When you'll add all this, okay, the addition of this comes to that is 9,10,000. Okay. Here you are not supposed to add the profit. Okay. No need to find out. If you'll find out, you'll just waste your time in board exam. Just find out weight and weighted profit. Okay. So now what you want to find out, that is weighted average profit. See, again I am telling, they have not told you to find out goodwill. Okay. So only this step. So total weighted profit upon total weight. See, in average profit, what was their average profit is equals to total profit upon total number of years. Here when you are using weighted average method, so total weighted profit upon total weight. Okay. So total weighted profit is 9,10,000. When you divide this amount by total weight, so the total weight is 10. Okay. That is 4 plus 3 plus 2 plus 1. So divided by 10, what do you get? You get that is 91,000. 9,10,000 divided by 10. So the answer is 91,000 rupees. Okay. So this is your weighted average profit. Okay. Now we'll start, that is sum number 7. From the following information of Babulal and Kantilal firm, determine the value of goodwill on the basis of 3-year purchase. See, purchasing year is how much? That is 3 years. Okay. Of last 5-year weighted average profit. Again they have specified that the method is weighted average. How we will cross check? So see, the amount of profit 40,000, 60,000, 75,000, 90,000 and 1,20,000. Okay. So continuously the profit is increasing. When the profit is increasing continuously, so if it is not mentioned also that find out the sum by appropriate method and the method is not mentioned, then you will use weighted average profit. Okay. But here in this sum they have already given that the sum is based on weighted average profit. Clear? Now we'll do the sum. So come here. Now see, in this, year is given, profit is given. Now we know that the sum is based on weighted average method. So we will write down the weight. What is the weight? So 1, 2, 3, 4, 5. And the total of this comes to that is 15. 5 plus 4 plus 3 plus 2 plus 1. Clear? Now what you will find out the next step, that is weighted profit. Okay. So 40,000 multiplied by 1. The answer is 40,000. Okay. Here it will be in rupees. 60,000 multiplied by 2. So it is 1,20,000. Okay. Then 75,000 multiplied by 3. So it comes to 2,25,000. Okay. Then 90,000 multiplied by 4, so that comes to 3,60,000. Okay, and then last 1,20,000 into 5, so that comes to 6 lakh. Okay, we are supposed to do the total of weight and weighted profit. So the total of this all 40,000 plus 120, 2,25,000, 3,60,000, 6 lakh comes to 13,45,000. Clear till here? Now what will be the second step? So you will find out weighted average profit, that is equals to, you have to write down this, total weighted profit upon total weight. Okay, which is equals to 13,45,000 divided by 15. So the answer comes to, that is, it comes in point. Okay, when you divide this two number, 89,666.67. so approximately we can take it as 89,667 rupees. Is that much clear to everyone? Now further what you will do, you are supposed to find out the amount of goodwill. Okay, so we will write down goodwill is equals to weighted average profit multiplied by number of purchasing years. Okay, so weighted average profit is 89,667. Okay, round figure we will take. Number of purchasing year in question they have given that it is of 3 years. Okay, so here we will multiply it by 3. So what do you get? You get that is 2,69,000. Okay, 2,69,000 rupees. Now see, when you do this on calculator, okay, 89,667. See here, when we multiply 89,667 into 3, what do we get? Okay, 89,667 multiplied by 3. Okay, we are getting the amount like this. Okay, it is not coming in round figure. So what you will do, see what you have divided. So again see, that is 13,45,000 divided by 15. So 13,45,000 divided by 15. So you are getting like this figure, 89,666.66666. So here though we have written in round figure, but when you will multiply it by 3, you will multiply this amount by 3. Okay, so see now when I am multiplying it by 3, okay, what amount I am getting? 2,68,999.999. So as there are 0.99, so we can convert it into round figure, and the round figure will be, that is 2,69,000. Clear to everyone how this amount is coming? Now we will start question number 8. That is, Pushpa, Pratibha and Bhavna are partners of a partnership firm. They decided to change their profit loss sharing ratio from 3:2:1 to 1:1:1. Earlier also I have told that in Goodwill chapter you are not supposed to take into consideration the ratios. So these ratios are just useless to you. Do not take into consideration anywhere. Okay. Therefore, they have decided to make the valuation of goodwill. As they are changing this ratio, they have just given us the information that as they are changing this ratio, that's why we are supposed to find out the amount of goodwill. On the basis of partnership firm profit and other information, determine the value of goodwill on the basis of 3-year purchase of super profit. See, now first of all, we have seen two methods. One is average profit method. Second is weighted average method. Now this is the third method, that is super profit method. And in super profit method, when I explained the theory portion, I have told you that remember 6 steps. Okay, which are that 6 steps? So 6 steps are, that is CEE, GSG. Okay, CEESG. This 6 steps you have to remember when you are doing super profit method. Okay, we'll see which are these 6 steps. And here in this sum, what they have told you, the purchasing year is how much? So 3 year is the purchasing year. So if you want to record somewhere, you can record here that purchasing year is, that is 3. Okay, like this we will record for just remembrance. Okay, now we'll turn the page because the detail is given backside to us. See what they have given. Asset is 6 lakh, liability is 2 lakh 50. Okay, then expected rate of return given to us, that is 10%. Okay, and then they have given us, that is actual profit and profit. Okay, so what is the profit, how they have given? See, now here, as this is super profit method, here we have to decide that which method will be applicable. See, 80,000, then reducing, then again increasing. So here the profit, how the profit is it? The profit is fluctuating. Okay, and as the profit is fluctuating, we will use which method? So average method. Clear? In this particular sum, which method you are supposed to use? That is average method. If the profit was continuously increasing or decreasing, then we would have used here weighted average method, but in this case we will be using, that is average method. Okay, now we will see that 6 steps which we are supposed to follow in this super profit method. See, CEEASG. C stands for capital employed, E stands for expected rate of return, again E stands for expected profit, A stands for average profit, S stands for super profit, and G stands for goodwill. Okay, capital employed, what is it? So total asset minus total liabilities. Okay, expected rate of return, that is directly given, we will just only note down it. Expected profit, so what is this? That is capital employed multiplied by expected rate of return, that is one number is to be multiplied by number 2. Okay, so the first number is to be multiplied by number 2. Clear? So that we will get. Then average profit, so here in this particular sum we will write down the year and profit like this. Okay, so average profit. Now which method we are supposed to use in average profit? So we have seen that the profit is fluctuating. Okay, 80,000, 70,000, reducing and again increasing. So here we will use method is average profit method. Okay, this method we are supposed to use. Clear? After calculating and finding out average profit, the next step will be super profit. So what is the formula of super profit? Average profit minus expected profit. I have told you shortcut that when you are reading the ABCD in an alphabetical order, A comes first. So here also you will write down A first and then you will write down E, that is expected profit. This is just a shortcut how to remember, so there is no chance of making any mistake. Okay, then last step, that is goodwill, which is equals to super profit multiplied by number of purchasing year. Okay, now we will do the sum. See, first step, capital employed, so total asset minus total liability. See, they have mentioned in the sum asset is 6 lakh and liability is 2 lakh 50. Okay, so we will just write down here, that is 6 lakh minus 2 lakh 50. Okay, so what do we get? That is 6 lakh minus 2 lakh 50. The answer comes to 3 lakh 50. Okay, so this is your capital employed. Clear? So first step is over, capital employed is coming, that is 3 lakh 50,000. Second step is expected rate of return. So in the question itself they have given, see what is the amount percentage of expected rate of return, that is 10%. So we will just simply note down here that the expected rate of return is 10%. Second, we will find out expected profit. What we are supposed to do? So capital employed multiply by EROR. What is this EROR? So expected rate of return. Okay, this is the short form of expected rate of return, that is EROR. So see, what capital employed we have find out the amount, that is 3,50,000 multiply by, that is expected rate of return, that is 10%. So the amount of expected profit, it comes to 35,000 rupees. Clear? So expected profit is, that is 35,000. Now fourth step will come, that is average profit. Okay, we have already seen that here the profit is increasing, decreasing, so we have to follow the first method, that is average profit method. So what is the total profit here? So total profit after adding 80,000 plus 70,000 plus 90,000, you get 2,40,000. Clear? This is your total average profit. Now we will write down the formula, that average profit is equals to total profit upon total number of years. So 2,40,000 divided by 1, 2 and 3. So divided by 3. What do you get? That is 80,000 rupees. Okay, so this is your average profit. Clear, everyone? See, at the end, do not forget to write down of the rupee. Okay, that is either the symbol also you can use of a rupee. Okay, now the next step, that is super profit. Okay, what is the step of super profit? So average profit minus expected profit. So see, average profit, what is the amount? 80,000 minus expected profit, what is the amount? So that is 35,000. So here we will write down 35,000. Now 80,000 minus 35,000, so the super profit amount will be how much when you will deduct? So 45,000 rupees. So this is super profit. Okay, now the last step you have to do, that is goodwill. So super profit, the amount of super profit is 45,000 multiplied by number of purchasing years. Okay, so what is the number of purchasing year? We have seen, we have written here also, so that we are not supposed to turn the page again. So purchasing year, or we are not supposed to see again in the question. So purchasing year were 3 years. So here we can write down directly that it is of 3 years. So what do you get? That is 45,000 multiplied by 3. So the answer is 1,35,000 rupees. Okay, this is your goodwill. Clear to everyone? Okay, this is your answer. Now we will see sum number 9. Capital of Meena and Manju's firm is rupees 4 lakh. See, your capital means that is capital employed. Okay, so remember that capital means they are talking about capital employed of Meena. That is directly given, no need to deduct. That is total asset minus total liabilities, no need to do that. Then what they have told you, expected rate of return is 10%. Last year's profit is 1,20,000, 1,10,000 and 1 lakh. See, it is continuously reducing. 1,20,000, then 1,10,000 and then 1. So as it is continuously reducing and fluctuation is not there, but it is continuously reducing, so we will go by weighted average method. Okay, compute the value of goodwill 2 times of super profit. So now here which method they have told us to do? That is super profit method. And what is the purchasing year? So 2 times. So 2 times. Okay, that is, this is your purchasing year detail given. So 2 times. Okay, now on the basis of a weighted average method, see here they have mentioned weighted average method. So if this word is not mentioned weighted average method, then we can see that it is continuously decreasing, and we can take by our own, that is weighted average method. Now see, as super profit method is there, so what was the step keyword? So that is CEESG. Okay, capital employed, expected rate of return, expected profit, average profit, super profit and goodwill. Okay, these are the 6 steps. First step, capital employed, total asset minus total liability. In this sum it is not needed. Why? Because directly capital of Meena and Manju, it is given that it is 4 lakh. So no need to do any deduction. Directly you will write down here that the amount of capital employed is 4 lakh rupee. Okay, so no need to write further. Then second step, expected rate of return. See, what is the amount of expected rate of return? It is 10%. Can you see here? 10%. Okay, so here directly we will write down 10%. Okay, now expected profit. So what? number 1 is to be multiplied by number 2. Okay, so capital employed is 4 lakh, multiply by 10%, so that comes to 40,000 rupees. Okay, so this is your expected profit. Clear? Then average profit. In this sum we have already discussed, as the profit is continuously decreasing, that's why we will do by weighted average method. Okay, so here profit is already written. Now we will write down weight. So 1, 2, 3, the total comes to 6. Okay, now weighted profit in rupees we will write down. Okay, so first 1,20,000 into 1, what do you get? So 1,20,000, 1,10,000 into 2, so we will get 2,20,000, 1 lakh into 3, so we will get 3 lakh upon, what is the total of all this? So 6,40,000 rupees. Now what we are supposed to find out? So we will find out weighted average profit is equals to, okay, so total, don't do directly, again I am telling, weighted profit upon total weight. Okay, you have to write down this much. So 6,40,000, okay, divided by 6. What do you get when you do 6,40,000 divided by 6? So see, that is 6,40,000 divided by 6. See, again the answer you are getting, that is in point. Okay, so again how we will write down? That is 1,06,667. Okay, we will write down like this. So we will write down here like this. Okay, that is 1,06,667 rupees. Okay, like this you will do into round figure, or you want to show this, you can show it. See, this we can write down also in point, and then if you want to show, you can show like this. That is, the answer was 1,06,666.66. okay, so like this it is going. So approximately we can write down like this, that 1,06,667. Now next calculation, what you are supposed to do? This was weighted average profit. Okay, this is our weighted average profit. Okay, so now we are super profit, average profit minus expected profit. As this is weighted method, so this we will take it as weighted average profit. So the amount is 1,06,667 minus our expected profit was, that is 40,000. Okay, so here we will write down minus 40,000. What amount we are getting? So when you deduct this, we are getting 66,667 rupees. Okay, this is your super profit. Clear? Now super profit we will write down, that is 66,667 multiplied by number of purchasing year. So what they have mentioned, you have to take 2 times purchasing year for the super profit method. So here you will multiply it by 2. Okay, so what you are getting? So the amount we will get, that is 1,33,334 rupees. Okay, this is your goodwill. Clear to all of you? Now let us start sum number 10. From the following information of Nairutwa and Rutvik firm, determine the value of Goodwill partnership firm on the basis of capitalization of weighted average profit method. See, they've mentioned that the method is capitalization. So now we will start our fourth method, that is capitalization method. Second thing, they have themselves given that it is weighted average profit method. See, you can see the profit 45,000, 50,000, 65,000, 75,000, 90,000. Okay, what it is continuously increasing. Okay, so here if they have not mentioned that weighted average profit, then also we would use this method only, because this method is only applicable. Additional information they have given that asset is 6 lakh, liability is 1,70,000, and normal expected rate of return is 10%. Okay, so on this basis now we will find out the goodwill amount by the method of capitalization. Okay, in this I have told you, remember 5 steps. Okay, see how we will remember this 5 steps. See, first and second is same, capital employed, then expected rate of return. Now in super profit method, what was coming? Expected profit, so omit that. Okay, and what was the fourth one? Average profit, so fourth one directly comes here. Okay, then after fourth one it was that is super profit, so in place of super profit what is here? Here it is capitalized profit, and then after capitalized profit what is there? So goodwill is there. Okay, so these are the 5 steps which you have to remember for the capitalization method. Clear? Now see, we will start the sum, that is capital employed. Okay, what is the formula of capital employed? So total asset minus total liabilities. Okay, the additional information they have given that total asset is 6 lakh and liability is 1 lakh 70. Okay, so we will do that. See, so here we will write down that is total assets were 6 lakh. Okay, and total liabilities were 1 lakh 70. Okay, when you will subtract this, what you will get? You will get 4 lakh 30,000 rupees. So this is your capital employed. Clear? Then what is your expected rate of return? That is given in our question, that is it is 10%. Okay, so we will write down here that it is 10%. Okay, now we will do average profit. They themselves have mentioned that you have to follow weighted average method. Okay, but if this is not mentioned, then I have told you, then when the profit is continuously increasing or decreasing, you have to use this method. Now what you will do? You will write down your weight 1, 2, 3, 4, 5. The total of this comes to 15. Okay, same way now we will write down weighted profit. Okay, so weighted profit, what you have to do? You have to multiply this two. So 45,000 into 1, it comes to 45,000. 50,000 into 2, so it comes to 1 lakh. 65,000 into 3, so it comes to 1 lakh 95,000. Okay, then 75,000 into 4. Okay, so it comes to 3 lakh, and 90,000 into 5, so it comes to 4 lakh 50,000. The total of all this 45,000, 1 lakh, 1 lakh 95, 3 lakh, 4 lakh 50, it comes to 10 lakh 90,000. Clear? Now see, what you will do? You will find out weighted average profit, that is equals to total weighted profit upon total weight. Please do not forget to write down this formula in exam. So 10 lakh 90,000 upon 15. What do you get? So you get that is 72,667. Again see here, when you do on calculator you get the figure like this, that is 10 lakh 90,000 divided by 15. Okay, you're getting like this in point. Okay, so now enough practice you have done, so I'm writing directly that it is 72,667 rupees, that is weighted average profit. Okay, is this much. Clear? Now see, next is capitalized profit. Okay, the formula is average profit upon expected rate of return. So see, that is average profit, which is here weighted. Okay, so how you will remember? Which is equals to 3 upon 2. How you will remember here? 3 upon 2. See, if you do not multiply it by 100, then also you will get same answer that I'll show you. Okay, here in formula in textbook it is written, so I have written here. See, what is the weighted average profit? So 72,667, 72,667. Now expected rate of return is 10%. So if I am writing 10, okay, only 10, and I am not showing percentage, then I am supposed to do multiplied by 100. See what is my answer? I'll show you again this on calculator. Okay, that it is 72,667 divided by 10 and multiplied by 100. My answer is coming, that is 726,670. Okay, rupees. That is 7,26,670 rupees. This is my capitalized profit. Now option or I'm showing you, okay, that it is C. This was the answer. Now or in option I am showing you that if I am not writing this 100, then what is my formula of capitalized profit, which is equals to average profit upon expected rate of return. No need to multiply it by 100. So see, now what I will do, that it is 72,667 divided by 10%. Okay, so if you are doing writing your percentage sign, okay, so no need to then write down this 100. See, here I have not written percentage sign and here I have written percentage sign. So see, now what you'll get, 72,667 divided by 10. Instead of multiplying it by 100, we will press directly, that is percentage sign. See, again getting same answer, that it is here we will write down 7,26,670 rupees. Okay, so either go by this method, mention 100 here, or if you are not mentioning 100 and here you are showing percentage sign and directly you are pressing percentage sign. In both the circumstances the answer is same. Clear? Now the last step, that is goodwill. Fifth step, capital profit. So our capital profit is 7,26,670 minus our capital employed. Capital employed, it was how much? So 4,30,000. I told you here that what you have to do in this step last. So 4 minus 1. Okay, here it is 3 upon 2. Remember shortcut, here it is 4 minus 1. So capital employed is 4,30,000. So our answer comes to, that it is 2,96,670 rupees. Clear? This is your amount of goodwill. Okay, now let us start sum number 11. Determine the value of goodwill of Prabha and Prabhu's firm on the basis of capitalization super profit method. Okay, so this is our fifth method, which is a combination of capitalization and super profit method, which I have discussed in the theory, that in this method, when it is capitalized super profit method, the combination of both, you will follow the steps of super profit method. Only the last step, okay, that was goodwill. The formula was, that is in super profit method, super profit multiplied by number of purchasing year. So here the last step for goodwill, it will be super profit upon average expected rate of return. Okay, or you can even multiply it by 100 as I showed in the previous sum. Okay, so these are the method. Here you are supposed to follow that same 4 steps, capitalization, super profit method. Okay, so see, now capital employed, the formula is total asset minus total liability. In the sum they have given that capital employed, it is directly given, so no need to do the deduction total asset minus total liability. Capital employed is directly given, that is 9 lakh. So here we will write down directly that it is 9 lakhs, okay, rupees. That is capital employed. Okay, then expected rate of return. How much expected rate of return is shown? That it is 12%. So here we will directly again write down that expected rate of return is 12%. Okay, then after that third step, again same, capital expected profit is equals to capital employed into expected rate of return. Okay, so here see, capital employed is how much? 9 lakh multiplied by 12%. So here we will do 9 lakh multiplied by 12 12%. Okay, what do you get? That is 9 lakh multiplied by 12%. So here in this particular sum we get 9 lakh multiplied by 12%, that is 1 lakh 8,000. Okay, so 1 lakh 8,000 rupees. Okay, this is our expected profit. Okay, then average profit, see now not mentioned which method. So see 1 lakh, then 1 lakh 40, increasing, then it is decreasing 1 lakh 30, then it is again increasing and again increasing, but here in between there is decreasing, so there is fluctuation, and because of that here we will use only average method. Okay, not a weighted average method. Okay, so this method here we are supposed to use. So what is the total profit? So the total profit of all this is 1 lakh, 1 lakh 40, 1 lakh 30, 1 lakh 50 and 1 lakh 80. It comes to 7 lakh. Okay, now we will write down average profit is equals to total profit upon total number of years. Okay, so what do we get? 7 lakh divided by how many years are there? 1, 2, 3, 4 and 5. So 7 lakh divided by 5. Okay, so what do we get? Our average profit, that is 1 lakh 40,000 rupees. Clear? This is our average profit. Okay, now super profit is equals to average profit minus expected profit. So average profit is how much? 1 lakh 40,000 minus expected profit, it was how much? 1 lakh 8,000. So here we will write down 1 lakh 8,000. So 1 lakh 40,000 minus 1 lakh 8,000, it comes to 32,000 rupees. That is super profit. Okay, now accordingly the sixth step, that is goodwill. Here you won't do the you will not use the formula which we are using in super profit method. Okay, this is a combination of both capital and super profit, so it is capitalized super profit method. Okay, so here in this case you will do super profit upon expected rate of return. So see, if you are multiplying, first I'll write down this much. Super profit is how much? 32,000 divided by how much it is the expected rate of return? 12%. See, if I'm only writing 12, then I'll have to multiply by 100. If I don't want to write multiplied by 100, here what I will do, I'll put the percentage sign. So see how we'll get 32,000, okay, divided by 12. Directly we will press this percentage sign. Okay, what you are getting, that is 2,66,666 point. So directly we will write down here that 2,66,667 rupees. This is the amount of goodwill. Clear to all? Now see the last sum of this chapter, that is sum number 12. Rajesh and Harish are partner of a partnership firm. On the basis of their partnership, okay, firm profit and other information, determine the value of goodwill on the basis of 2-year purchase of super profit. It means this is a simple sum, only everything is given. You have to do the sum by super profit method, for which you have to follow the 6 step. That is, the 6 steps are CEEASG: capital employed, expected rate of return, expected profit, average profit, then super profit, and then goodwill. Okay, and simple sum, that is that 6 sums. Okay, goodwill last. See this, I'll show you. Okay, this 6 step which we have done in question number 8. Okay, that only you have to follow. Okay, capital employed, so total asset minus total liability, expected rate of return, it is given. You will calculate expected profit, then average profit. Okay, then super profit, and then goodwill. So super profit multiplied by number of purchasing year. In this sum, see what is the number of purchasing year. So here they have given on the basis of 2 years. So your number of purchasing year is 2. Here which method will follow, average profit or weighted average? So see, 1 lakh 20, then 90 and 1 lakh 50. 1,20,000, then decreasing and then again increasing. So there is fluctuation. So you will use a simple average, that is average profit. Okay, total profit upon number of years. So this sum I think you can do by your own. Still, if you have any query in this chapter, you can ask the questions, okay, by putting it in the comments. Thank you.